Good morning. I am Siang and I will be the moderator for today's forum. First of all, we would like to thank all of you for joining us at this forum on a Saturday morning. In today's year-end investment forum, we will discuss the aftermath of the US election and what it means for markets. This forum is proudly brought to you by The Edge Singapore and sponsored by TD Ameritrade Singapore. Now we would like to invite our first speaker, Professor Pushan Dutt, Professor of Economics and Political Science at INSEAD and the Shell Fellow of Economic Transformation. Professor Dutt to be speaking on whether China's economic recovery is sustainable and if the US-China trade and tech war is going to be prolonged. Over to you, Professor Dutt.
Thank you very much. So let me just share my screen and then I'll just get started. Okay, so good morning, everyone. So I'm going to talk about a couple of things. The first thing I'm going to talk about are some of the challenges that lie ahead for China, especially on the economic front. And I'm also going to talk about, the current geopolitical tensions between the US and China and a potential way forward. So I'm a data person, so I'm going to start you off with some data and just give you some historical context. So what I'm going to do is do a brief comparison of how sort of China has evolved since 1980. So what this pie chart is showing is the relative importance of different countries in world GDP, in world production. And if you look at it, you see that China in 1980, this is right after its reforms, only had a 2.3% of world GDP. Now we fast forward to today, and you can see that China now has close to a 20% share of world GDP, which is actually higher than in the US. So by this measure where we use purchasing power parity calculations, China is actually the world's largest economy. Now, we can take another longer term perspective and try to imagine a world where the following has happened. So think of a world where all countries in the world, China including, have done what Singapore did. So what did Singapore do? Singapore essentially started off as a poor country. It grew very rapidly, and today its per capita GDP is higher than that of the US. So what would such a world look like where China actually sustained its growth going forward and its per capita GDP became that of the US? Let's make a heroic assumption and assume that all countries in the world actually managed to do that. So not just China, but India, Brazil, Russia, etc. So what would this pie chart look like? And in that case, the pie chart looks fundamentally very different. So what we see here is that the US then will be a very small fraction of the world's GDP. It'll be about 4%. Where do you get this number from? So the calculation is actually very simple. If all countries have the same per capita GDP, then their relative share in world production will essentially be given by the relative share in world population. This is essentially the demographic component which actually comes to dominate over the long term. So China and India would be the giants. The US would be less than 5%. The European Union would be less than 5%. So this would be a fundamental transformation of the world, and this is likely to happen in our generation. Of course, not all countries will manage to do the same, and there are some questions remaining about whether China will be able to sustain its growth going forward. Here's another way to look at this comparison. So this here I'm comparing 1980 to 2020. So in 1980, for instance, Chinese GDP on a purchasing power parity basis was only 10% that of the US. Today, it's about 116% out of the US, so it's 16% higher. You can also do the calculation in terms of the current exchange rate, and you get slightly different numbers, but the transformation is equally staggering. If you look at exports, for instance, Chinese exports as a percentage of US exports was 6% in 1980, and they're about 150% today. On GDP per capita, which takes into account, which is essentially GDP divided by population, we can see that China has, caught up to the level of the US somewhat, but, the numbers are not so stark. It was 2% compared to the US. Today, it's 26%. So what this shows is that the China growth story essentially has still a long way to go. Now, we should not always think about this in sort of like a zero-sum context. We should also think about that, the Chinese population have benefited massively in terms of growth. and in terms of moving vast numbers of people out of poverty. So if, again, you look at 1990, this is showing the world's income percentiles in tenths. You can see that China in 1990, most of the world's poor were actually coming in from China. This is where this red mass around the world's poorest is sitting. Again, if we fast forward to the latest year that we have data for, to 2016, what we see is that, essentially what has happened is that China now accounts for the world's biggest share of the middle class. So we've seen about 800 million people actually move out of poverty in this time. Now, U.S. presidents over time have almost always, miscalculated the Chinese story. So for a long time, they essentially thought that this was essentially about capitalism, laissez-faire markets opening up. But China's economic model has been, of course, very different, sort of state-directed capitalism. The second mistake that they've made consistently is about, that economic freedom comes first and then political freedoms will follow inevitably. So here is President Reagan saying that, going to China, that, once China opens up, there is a taste of freedom for over 1 billion people. George Bush saying that economic freedom is the only source of national wealth, but very soon China will find that, social and political freedom is shortly likely to follow. But this, of course, hasn't happened. Perhaps the president who got this the most wrong was Bill Clinton, who said that in the 1990s, he said China has been trying to crack down on the internet. Good luck with that. That's sort of like trying to nail Jello to the wall. And it turned out that he had simply not anticipated the Great Firewall, where China actually exercised a lot of control over the internet. Again, we fast forward to Donald Trump, and what we see is that a huge trade war, perhaps one of the biggest trade wars that we've seen in a long time, emerges, and that happened over almost 2 years. Of course, this was not a very well executed trade war. It was executed through tantrums by Donald Trump. It was also singularly ineffective because the cost of the trade war was actually borne mainly by American households. So one of the newest estimates shows that the trade war actually shaved off about 1% of US household incomes. It was also ineffectively implemented. Trump allowed the dispute settlement mechanism of the World Trade Organization to fall by the wayside. He needlessly antagonized the allies. And finally, when the trade war actually comes to an end, it's not clear what the path is sort of going forward, especially because there's a new administration which is going to come in on January 20th. Now, what's likely to happen when we transit from the Trump administration to the Biden administration? Basically, things will revert a little bit back to the normal. We will go back to the old boring ways of settling disputes between countries, especially trade disputes, which is either through WTO mechanisms or through back channels and informal channels. So do it quietly instead of over Twitter. And I think that would be a good both from the US perspective and from the Chinese perspective. But at the same time, we have to recognize there are two big contentious issues which remain. One is about technology transfer, which is about IP protection, big industrial subsidies for the next generation industries. That problem has not been solved. And second, the deep disagreements on human rights actually continue to persist. And there are parts of the Biden administration which will actually take advantage of the Trump tariffs to try and address all of these human rights issues that the US and China deeply disagree about. This has led many people to invoke this thing called the Thucydides trap. So 2,400 years ago, a Greek historian called Thucydides, he sort of highlighted the issue that whenever there is a rising power which encounters an established power, this almost inevitably leads to war and conflict. So political scientists and historians have looked at this, and they found that 12 of the last 16 major transitions has actually led to war. And one of the big, a couple of the big ones is Britain and Germany. Even one which is classified as not a hot war led to a cold war, which was the US and the Soviet Union. Thucydides was talking about Athens versus Sparta, and what happens in that context is the Athenians and the Spartans fight. The Spartans eventually win, but they're massively weakened by it, and this opens up the door for the Persian invasion, and the Persians actually come and take over. So one interesting question is that if the world falls into this Thucydides trap, who are the Persians? Okay, if the U.S. and China actually persist on doing conflict. While it's very difficult to forecast these things, that this is likely to happen, that there will be war or conflict, we have to recognize that we live in a time of deep disruption, which is sort of being accelerated by the COVID healthcare shock. So in my view, I think, going back to the unipolar world that existed, is infeasible. We are going to move to a world which is more multipolar, a world where, the US-China axis essentially, sorts all of the world powers into different teams. I also think that we will not go back to the spirit of hyper-globalization and free trade, and that we will see more protectionism coming, and we see its emergence in both advanced economies and emerging markets. And finally, this notion of a global citizen has fallen by the wayside, and countries, regardless of whether we are thinking about the US or the UK or China or India, we see a rise of nationalism and a move away from sort of global cooperation, which means that the world is going to be quite different as we go forward. Now, there are two roads forward. One is a return to the status quo, okay, which is what most people are hoping for, which, with the Trump administration gone, that, the Biden administration will come in, they will revitalize the Western alliance, they will strengthen multilateral institutions like the WTO, the United Nations, and NATO, and that we will return to the spirit of globalization. Along this way, the Americans will accommodate Chinese ambitions in the Asia Pacific, accommodate its ambitions in advanced technologies, and sort of de-emphasize human rights and democracy. I'm a little skeptical whether this is going to happen. I think the hyper-globalization period is not, we are not going to get a smooth return to it, because domestically there's a lot of opposition in advanced countries towards going back towards an era of free trade. I also think that U.S. policymakers and the U.S. foreign establishment has become more aggressive, and they're unlikely to do this trade-off. Let's go back to where we were and let's accommodate Chinese ambitions in these technologies in different parts of the world. I think they're going to increasingly challenge it. The other option essentially is, and this is a scarier option, is that the Americans will continue the bellicose approach to China. They will follow this overt strategy of containment with sustained military buildups. There's some talk even amongst the incoming Biden administration about that. On the economic front, there's likely to be a push to decouple from China, especially global supply chains, build a supply chain for China and build a supply chain for the rest of the world. We can see Foxconn already trying to implement a strategy like that. Here, the gains from trade and investment are sacrificed, and we have a zero-sum outlook. Now, I'd like to suggest that we have to recognize that some form of conflict is inevitable, but we should sort of try to carve out some realms for cooperation. So here's a potential framework to think about what the world order might look like in the future. There might be a bucket of prohibitions where countries are simply not allowed to do these things. The objective here is to minimize military conflict, rely on the UN Charter where violations of sovereignty is not allowed. In this bucket, I would also put things like economic policies, which economists call beggar thy neighbor policies. And an easy example would be that you try to depreciate your exchange rate to boost exports, but of course that means it's somebody else's exchange rate is appreciating, and their exports are not going to be boosted. The world economy as a whole is closed, so one country's exports is another country's imports, so the world as a whole cannot boost exports simultaneously. Similarly, tariff wars, where you're trying to protect your domestic sector, at the expense of the foreign sector, these things should sort of be prohibited. The second bucket is a bucket where positive sum solutions exist, and these have to be achieved through negotiation. So much of trade and investment will have to happen here. new regimes of intellectual property protection have to be put in place. Arms control has to be pursued. There has to be cooperation on global pandemics. And here I can see a lot more cooperation between not just US and China, but also European Union, India, Brazil, etc. And finally, there's a bucket of issues which are sort of autonomous, which are purely domestic and target domestic objectives. So what kind of financial standards or financial regulations countries impose? What kind of environmental policies or labor standards it adopts? What are the corporate taxes that it chooses? Here, it's sort of also important that there should be some form of non-interference in third-party relations. So just to take the Huawei case, for instance, the US says that Huawei is not allowed to participate in US markets. That's sort of fine. But in other markets, when it's putting pressure on the UK for Huawei not to do this, that should actually not be pursued. Of course, a framework which sort of minimizes the risks and sort of, carves out some places for cooperation. This is going to take a lot of legwork and a lot of consensus amongst different countries. Now, China also faces a couple of challenges. The first thing, of course, is slowing growth rates. So around 2010, you can see that the growth rates essentially start slowing down. So in my opinion, the era of like 10% or 7% growth rates are sort of over. The best we can hope for is 5 to 6% growth rates in terms of per capita GDP. Basically, the demographic dividend is over in China, and now the dependency ratios is increasing rapidly as the population ages, and estimates show that by 2050, about the dependency ratio goes up to about 67%. So therefore, China has to think it's no longer about investment and throwing workers and accelerating growth rates. The big challenge, I think, that remains for China, which Ben Bernanke emphasized during the global financial crisis, is this problem of imbalances. Essentially, the Chinese economic model, which was highlighted by their premier in 2007, that it's uncoordinated, unsteady, imbalanced, and unsustainable, that I think continues to remain the case. So how do we sort of see it? Essentially, if I look at household consumption, there has been a steady decline. So China has always been an investment-driven growth model and not a consumption-driven growth model, which makes, even though the Chinese market is big, it's less attractive from many firms' perspective. The problem with the investment-driven growth model, of course, it runs into diminishing returns. You run out of ideas. Now, because China has been, producing a lot and not consuming enough, what it does is it exports all of this surplus and runs up these vast amounts of foreign exchange reserves. These foreign exchange reserves essentially get parked into US treasuries, driving down interest rates in the US. And this is a long-term phenomenon. This is the savings glut that Bernanke referred to. Driving down interest rates, of course, creates asset price bubbles, and this has been sort of hypercharged with the current COVID shock, where short-term interest rates essentially have been driven down to zero. The Chinese essentially buy 10-year treasuries, so they drive medium-term interest rates. This creates massive volatility in financial markets, and something has to change. The US right now has always been the engine of the world's demand, but China has to make a transition from this investment-driven growth model to giving a bigger share to households, to getting a bigger share to innovation. So from China's perspective, I think China right now is struggling with these two parts. One is to continue along the investment-driven growth model, big investment, big projects. They've run out of these ideas within China. So as a result, they've started the Belt and Road Initiative, where they're trying to build this Silk Road, both over land and over sea. I'm skeptical about the Belt and Road Initiative because this has been tried in the past by other countries, other companies, where they're investing in these corrupt, politically unstable countries, and these things have not ended well. We're already seeing a lot of tensions happening in the relationships between these countries, which are the recipients, and China, and many of these projects are going bad. The second one is essentially China's 2025 plan, which is much more sustainable, which is, think about innovation, think about, dominance in the next generation industry. In this realm, they also have to, the Chinese have to decide that are they going to follow competition, provide IP protection, or are they going to follow the policy of picking sort of winners and losers. Right now, there's in this bucket of picking winners, and pushing national champions. But we know that in the long term, competition acts as the best incubator for innovation. And here, providing IP protection is very key. Financial reform remains a big challenge within China. There is a lot of bad debt sitting in the banking system. So the financial reform has to continue, especially with the target towards supporting innovation. Environmental costs, are challenges which not just China faces, but many other middle-income countries face. The demographic dividend I mentioned briefly. One thing I think is going to be increasingly true is that so far China has emphasized growth, but now they have to start thinking about distribution. They have to start thinking about equity. So it's not just about efficiency, it's more about equity. And finally, they have to worry about their political system as well, keeping an eye on political instability. So big challenges for China on the geopolitical front, on the innovation front, in terms of managing equity, in terms of designing policies for the new world. And of course, they will need a good dose of luck in order to do that. So thank you, and I'm going to stop here.
Thank you, Professor Dutt. If you have any questions for the professor, please post them in the Q&A section. Please also feel free to vote for your favorite questions so we can answer them during the panel discussion later. Up next, let's invite Howie Lee, economist at OCBC Bank. Howie will be sharing his thoughts on how the global economy is shaping up and how this will affect interest rates going forward. Over to you, Howie.
Right, thanks, Siang, and thanks, Professor Dutt. Thanks, everyone, for having me here today. Thanks for joining me on a Saturday morning on the economic recovery in 2021 from our bank's house point of view. For those of you who don't know me, my name is Howie. I'm an economist with OCBC Bank. And last year, around the same time this year, I remember it was at the National Gallery. I spoke on the same platform with the Age as well on economic forecast for the year of 2020. Of course, that all went up in smoke when COVID came about. But I think what was most memorable in my speech last year was that on that very same Saturday that I was presenting, I had an emergency operation on my spine on Monday, which was just about 5 days ago. I had a severe slip disc. There was a lot of slippage, so the doctors called me in. Did an emergency operation. Thankfully, thanks to our world-class healthcare system, as well as advances in technology, we had a pinhole surgery. I was able to go out on stage by Saturday, and therefore was able to present to most of you who might or might not have been there 1 year ago. Okay, so this was me about a year ago, lying on the hospital bed in NUH. And then something happened in between from then, and then the next 6 months. Internally, because I didn't feel fit, I didn't feel healthy, there might be a bit of fear trying to exercise as well because of a major surgery. I put on a lot of weight. As you can see, my face was much rounder. It's like a ball in there. I don't have a lot of pictures of myself, so a lot of my pictures are screen grabs of those that I did on television. And there you can see how round I look. That was internally. Of course, externally, there are other factors, right? Like circuit breaker means you can't move, then you snack a lot of potato chips, and then you don't move as much as well, so your metabolism rate drops, and you don't know that, you see, so you just pile on. I think I gained about 6 to 8 kg in 6 months. And then things turned a bit better in the following 6 months. I started to exercise a bit more, gain a bit more confidence in putting a bit of weight on the spine. And then, of course, with the risk of circuit breaker, I was able to go back to the gym, found a bit of motivation to make myself a bit healthier, and of course, eat healthier as well. So why am I telling you this whole story? Is because it does appear that any form of recovery, right, whether it be health or whether it be the global economy, follows a similar form of path, right? You can call this the deep recession that I had. It was an accident, it was severe, it was an emergency operation like what we are facing right now. A lot of emergency stimulus coming on, and you hope that it can rescue something somewhat. But the recovery will never be smooth, all right? Internally, of course, I was afraid to put weight to exercise on my spine. And from here on, there'll be a lot of displacements in the economy. There'll be structural dislocations. There'll be job gains. There'll be job losses. And then we might go into a new normal where it looks like the same, November 2020 and November 2019, But personally, I feel it's been a bit different for me as well. I no longer do exercises. I just train my upper body. I look the same because I eat a lot healthier and I don't eat potato chips anymore. And I think it'll be the same for the global economy down the road in 2021 and 2022, where it looks like we are back to pre-pandemic levels, but the amount of displacements that we are going to see would be of a severe magnitude. Right, so enough about showing my face on the PowerPoint slide. Let me go into the topic proper today. So for the rest of the remaining 15 minutes that I have, I'm going to break it up into two parts. The first part is on economic outlook, what we are seeing, and secondly, what are our views for asset prices in the coming year. All right, so the severe drawdown in GDP that we have in 2020 is nothing to scoff about. IMF estimates that the world has contracted about 4.4% this year. This is assuming that on a good year, normal GDP for the world grows around 4%, not so good 3%. So all in all, we lost about 7% or so as to speak. And in 2021, IMF estimates our recovery to be 5.2%. Right, so here is a very simple mathematical question for you. If you own a share price and it's $1 and you lose 50% today and you gain 50% tomorrow, would you have recovered all your losses by the end of tomorrow? Right, the answer is no, because when you lose 50% on $1 today, your share price goes to 50 cents. And when you gain 50% the next day, it actually only goes to 75 cents. So you never recover back to $1 actually. So when people tell you that we lose 4.4% today and then we gain 5.2% tomorrow, does it automatically mean that we have gained that 6% or 0.8% on a cumulative basis? Is not exactly true. If you put in the numbers in your calculator, you realize that by the end of 2021, the global economy has basically just recovered to pre-pandemic levels. In other words, from 2019 to the end of 2021, time would have stood still for the global economy. And from where you are standing right now in Singapore, that is probably true as well. 2020, you are fighting fires. 2021, you're trying to gain some form of normalcy. And only when you say Merry Christmas next year, then you feel that things might get better in the coming year and coming months ahead. So people ask us, is it a V shape? Is it U shape, L shape? The V is apparent because of such a sharp drawdown that we see in 2020 and the rebound we expect in 2021. But beyond that, if you look at 2022 onwards, it looks like it's going to be a flat path according to how IMF looks at the growth rates. So my answer will always be the same. It's going to be a W shape because there'll be ups, there'll be downs, and it won't be a straight path of recovery going forward. The virus, of course, will be the largest risk that will continue to impede our recovery. Every economy that has relaxed restrictions has always almost seen a new wave of infections. Taiwan is an exception, of course. Even at their peak, they had 20 cases a day, something that most countries can only envy. But you look at South Korea, look at Hong Kong, they're now battling their third waves. Each wave looks longer than the last. And going into the winter this year, it's not going to be an easy ride for most of the economies coming up with a strong winter, especially in the Northern Hemisphere. South Korea is looking at 500 cases a day. Hong Kong has dialed back the travel bubble with Singapore because of their own cases as well. And therefore, if each time you have a peak in your wave, you pull back your restrictions, you put on your restrictions, and then when it eases off, you put it off, that kind of underlines how our recovery path won't be linear in the coming year ahead, even if we have a vaccine coming on. So thankfully, the worst is likely over for most economies. In Q2, most of us, many economies that we track especially, registered contractions of more than 10%, the worst being the Philippines and Malaysia. Singapore was not that far off at minus 13%. We can argue that Asia generally has contained the virus pretty much better than US and Europe. But as you know, when a side of the world sneezes, we catch a cold as well. And until we see some kind of improvement on that side of the world, especially the US, we will continue to face the strains of the economic lockdowns and restrictions that the West is imposing. One of the brightest spots for us, of course, is that China has continued to lead the way in terms of their recovery. I track commodities a lot, so I like to put forth a couple of graphs here to show how China has been leading the way. Crude oil that China has demanded has hit a new record high in October. Iron ore imports for, of course, their infrastructure needs has hit a record high this year in July. And even the PMI that was released a couple of days ago, we saw the Chinese Caixin PMI hit 54.9 in November, which is the highest on record for the current series that started in 2018. So I think my economic talk won't be complete without me speaking a bit about Singapore. So we expect the Singapore economy to contract about 6.1% this year in 2020. The official forecast from MTI is about 6 to 6.5%. And then we expect the economy in Singapore to rebound 5% in 2021. All in, as we have spoken about the movements on percentages earlier, it does mean that by the end of next year, Singapore may have not recovered to pre-pandemic levels just yet, and we might only see the recovery back to 2019 levels in middle of 2022. We are not alone in that regard, of course. If you look at the bottom right graph, the likes of Thailand, Singapore, and Philippines are expected to only return to pre-pandemic levels in 2022. Malaysia may or may not make it by 2021. The exceptions are Vietnam and Indonesia, who would probably go back to pre-pandemic levels by next year. But that's only because they normally grow at 6% each year, being an emerging market, and it's not a comparable basis with Singapore. Right, the bright spot for us this year has been that that non-oil domestic exports have been holding up, or what we call NODX. We expect it to expand 4.3% this year, moderate to about 1.3% next year. A bit of a surprise because last year our exports declined 9.2% on the year. The lead drivers of growth this year are, of course, you see on the bottom left graph, the biomedical products, naturally because the world demands more of that now. And also electronics, which because people work from home and they require more semiconductors or upgrades on their IT systems from a company perspective. Demand for both are likely to abate next year. We see demand for cyclical goods like automobiles picking up, and that would shift some of the demand away to other countries that produce this kind of cyclical manufactured items. Of course, on our end, the retail sales have taken the biggest hit. Supermarkets have outperformed the most because I'm sure all of you have gone to cold storage and Siang to shop during circuit breaker because there's nowhere else to go to anyway. But departmental stores on the other end of the spectrum, 46% down year on year. Not surprising to see Robinsons having to close their stores when departmental stores have lost about half their revenue or half their performance at least based on 2020 capacity. On the other hand, of course, online sales have surged, displacing traditional modes of purchases. And that's what I was pointing about when I say we are entering a new normal of the economy. I look the same in November 2020 and November 2019, but we are really not the same physical condition anymore. And we think the trend is here to stay going forward as one of the major displacements of this COVID pandemic. Right, so with that, I've come to the end of my first part on the economic performance. So generally a bit of caution going into 2021 and 2022, especially with the vaccine still not entirely sure of whether it will perform on a large scale and the virus coming on and off. But despite the doom and gloom that we see on the economic aspect, it may not translate exactly like for like on the financial markets front. And let me explain to you in detail. There's a new set of inflation in town. There's a new boy in town. It's called asset inflation. But for those of you who are not familiar with the topic of inflation expectations, let me just quickly bring you through this. If today you were to think that the price of your basic goods and necessities will increase in a year's time, you would expect that your salary adjustment today will have to reflect an upward movement to compensate for the increase in basic goods and necessities. If you think your basic goods and necessities will increase by a big amount, you are going to ask for your boss for a bigger pay raise this year. And if he or she is not going to give it to you, then you're going to shift to another company who might give it to you. Okay, so those are inflation expectations. It has not materialized, but because you think it's going to happen, so you behave in this way. And if a company may or may not give it to you, okay, they won't give it to you this year because it's COVID, but in a normal year, they might or might not. If they don't give it to you, you're going to find someone who does. And this adds pressure on wages. It pushes salaries upwards. And in return, the firms have to raise the price of what they sell to compensate for your higher salary. And in turn, your basic goods and necessities will naturally see a higher price because the firms have raised their prices. And one big round later, because of your expectations of what inflation would be, you actually have caused it to be a self-fulfilling prophecy by causing your goods and prices, the price of your goods to have increased. So that's the whole idea of inflation expectations. It sounds easy on paper, but in reality, it can be very, very, very hard to control. It takes a lot of effort from central banks to do it. It takes a lot of months and years to put it under control. And it gets worse when it's on the other end, the deflationary spiral, when you think prices will go down and then you stop consuming. Okay, but that's for another day. So why am I talking about this is that normally inflation expectations are centered on, as you had mentioned earlier, wages and the cost of goods. So higher growth in income leads to higher inflation leads to higher growth in income, vice versa. You can see on the left graph, there's a very clear relation. When inflation goes up, your personal income growth goes up, and inflation comes down, your growth in income comes down. However, what we are seeing in recent times, especially in the last 10 years, is this idea of asset inflation. If you look at the bottom right table, 08 was still not that perverse because there was a lack of QE back then. So there's a GFC, your US GDP is contracting 0.1%. And when your economy contracts, you expect, price of houses should come off and equity levels should come off, right? So that happened in 08. And then 09, things started to change a little bit because there was QE, there was an implicit backstop by the Federal Reserve to ensure that the economy functions without corporates who were failing and were too big being allowed to fail. So your equities have risen, although your GDP growth in 09 was actually 2.5% contraction. Home prices still contracted because it's a hybrid between an investment and, of course, a residential unit that you live in. So we see that bit of mixed views on that front. But fast forward to 2020, 10 years of QE and distortion in the markets, GDP growth has been one of the worst on record this year, 3.7% expected for 2020. And yet we see home prices go up 6.3%. And we see the equities, as of what I've calculated this week, 10% up. And this is called inflation expectations on the asset front, where put away all your talk about valuations and whether it's overpriced. If people have that notion that asset prices are going to increase next year, regardless of what it looks like to be a bubble to you, they're going to keep piling funds into this. And this is mostly distorted by the amount of money that's been coming on in the economy, both from fiscal front and monetary front. And we expect this trend to continue pushing asset prices higher in 2021 and possibly beyond. Of course, on top of that, of course, we see no interest rate hikes from the US until 2023 or later. And of course, with Biden facing a divided Congress, we don't think that fiscal can be counted on to rescue the day. And hence, the Fed will be pressured to keep rates lower for longer. And to even accentuate that idea of how rates will be kept lower for longer, the Federal Reserve has recently shifted their mandate from targeting a single point of 2% to targeting an average rate of a period of time where they will allow inflation to overshoot. Now, looking at how inflation has been 1.8% across the last 10 years, is a very tall order to even hit 2%, let alone it being overshot by that level. So we think the Federal Reserve want to see 6 months of overshooting, and all in, it does mean that interest rates will stay low for the foreseeable future, at least the next 2 to 3 years. I'm going to skip this slide in the interest of time. The other thing I want to talk about is the idea of cyclical rotation. Since the vaccine breakthrough in early November, we have seen the most beaten out assets rising and the top gainers lagging. So on the equities front, we are seeing the top gainers being energy and financials. Tech has been lagging behind. Commodities was the same. Energy has risen, whereas the precious metals has sagged. Even the FX space, the most beaten out Asian currencies were the Thai baht and the Indonesian rupiah. And in the month of November, they were the top performers. Right. On the precious metals front, I do think that gold is currently undervalued. The deviation away from our model at current levels have been quite low. And we think that given the low dollar levels, as well as the low interest rates, as well as the amount of stimulus that will come on in the next couple of months, gold should continue to rise into 2021. And dollar weakness, we expect it to persist as the US is still battling the coronavirus and is still the only economy due for another major round of fiscal stimulus and potentially QE in 2 weeks' time in the December FOMC meeting. We think there will be a tactical relocation of funds away from the dollar to Asian currencies, and that would pose some problems for Asian policymakers. But for now, we expect inflows into EM markets, especially Asia, in the year 2021. So I'm running out of time. I'll just wrap it up quickly. We have vaccine materialization that might happen. Hopefully, on a broader scale, it would show some kind of high efficiency rate, and that would underpin underpin risk appetite for 2021. There will be bouts of uncertainty with the virus, as well as geopolitical uncertainties. But we don't think that governments and central banks around the world are that ready to pull back the support on their policy aid programs just yet. And therefore, we see markets as well supported next year. And there will be a cyclical rotation of funds from growth to value sectors that has already started and will persist into 2021. All right, key themes to start from the top again. We are going to see a normalized world in a post-COVID. It's the same but different kind of scenario. On the rates front, we think rates will stay low for the next 2 to 3 years with the front end very anchored. Back end might see a bit of a reflation as governments seek to fund their expenditures on the fiscal aid. But otherwise, even on a historical basis, rates should stay low throughout the yield curve. On the FX front, we think the dollar would continue to weaken. Credit, we see we are selective and we would choose those with better quality credits, especially on the high yield space. Whereas on the commodity front, we think that China's fiscal impulse, as well as underinvestments in oil rigs, as well as metal mining companies, would keep commodity prices supported into 2021 and possibly beyond. With that, I know I've run out of time, and I'll pass it back on to Siang. I know I've skipped a lot of the equity and bonds part, but happy to take on those questions during the Q&A later. Right, so yes, thank you for your time.
Thanks very much, Howie. Do post your questions for Howie in the Q&A section, including those for equity and bonds and stuff like that. And please feel free to vote for your favorite questions as they come up as well, so we can actually answer them during the panel discussion later. So now let's welcome our next speaker, Christopher Brankin, CEO of TD Ameritrade Singapore. Chris will be discussing the following topics: where US markets are heading, which asset classes investors should invest in, and what sort of long-term changes the US economy will experience given all the developments this year. Over to you, Chris.
Hello. I don't know if you guys can see me. I think I got to start my video. There I am. Hi. Welcome into my home on a Saturday morning. Thanks for joining, spending some time with us here today. This is the second Edge event of the year, and second one we've done virtually. Just like how Howie said, we did this one last year at this time at the National Gallery. And for me, like, it's always better. I like to see in-person live events. But in the COVID world that we live in, it's nice to be able to kind of spend 30 minutes, and then do a Q&A with with the folks, with you great folks here on Saturday morning here in Singapore. Always difficult kind of following a professor and a seasoned economist. Pushan I took some notes here, illustrated financial models, with opportunities and challenges for China. And I hope a more normalized kind of trade negotiation with Biden in office, rather than the more volatile Trump, with his tweets that might move markets overnight. So I think some.
Hi, Chris. Sorry, we can't seem to see your slides. So I was wondering whether it would be possible to share them up right at the moment.
Yeah, I thought. Let's see. Sorry, technical difficulties on me. Let's see. Here we go. Slideshow from the beginning.
Okay.
Right. Can you see it now?
Thanks, Chris. Yeah, you can see it now.
All right, great. Yeah, all right. Thanks for. So look, as I was saying, kind of a nice illustration, by Professor Pushan, and in terms of, some of the challenges and opportunities that we have, with China, and also kind of the change in the White House, and hopefully how that gets back to a little bit more of a norm in terms of some of the negotiation practices that the U.S., China, and the rest of the globe has together. And then Howie kind of outlined, he spoke on economic outlooks, and asset prices, and the challenges of the global economy, and kind of what he sees as more of a W-shaped recovery, as we kind of, learn more about, the vaccines and the other things that, are going to help potentially drive the markets, is continued central bank dovish policies around the globe. Is the U.S. going to continue to pump money into their system? All these things, might lead to some choppiness, which could potentially be, instead of that V-shaped recovery, we have more of that W, where we do have some ups and downs, kind of going forward. So all interesting things in terms of the, that they raised, and I think some great Q&A for us afterwards. For those of you who don't know me, my name is Christopher Brankin, and I came to Singapore about 10 years ago. It's one of my favorite stories, for a one-year contract. I had just gotten married in the U.S., and I came out to set up then Thinkorswim Singapore and for 1 year. And well, 10 years later, still happily make Singapore my home. My daughter was born here. It is something that, continue to live here into the future. And it's something that was an adventure that started 10 years ago that, now, this is home, no longer Chicago, back in the US. So I've been doing this for a number of years. I used to be a trader. I was a market maker and a broker on some of the big exchanges in the US, the Chicago Board of Trade, the Chicago Board of Options Exchange. And then I've kind of gotten into the whole financial services spectrum throughout the last 25 years. And this is something that I'm still super excited about, because what we get to do on a day-to-day basis is more about client education, how to use our trading platforms, things and tools that are available to the retail customer that were not available 10 years ago, 15 years ago, the price points, that all the things that help us have people remove barriers to access and to entry into the US markets is all something that, is what is my passion in terms of continuing to be able to teach people about this, and making, be able to provide our trading platform and the tools with it, for free to any of our customers here at TD Ameritrade in Singapore. Okay, so enough about me. I just want to, this is something that, if you've ever seen me speak, is something that I like to highlight. So we have lots of information, that have already been shared with you. But for me, what I really want anyone who's listening to this today is, my goal is for you to walk out of here, or I guess, turn off your computer for the day, is to kind of have at least one or two kind of investing ideas that might help better your investment strategy going into 21. So that's it. We have a simple goal. I want you to have at least an idea or two in terms of how we can potentially look to have a better outlook or perspective in terms of what you're investing in going into 2021. All right. So for my compliance folks, this little simple disclosure, it basically says that, hey, look, all the things I'm talking about today are for illustration purposes only. Any stock or sector that I talk about is not a recommendation to buy or sell it. So thank you for that. So now, slightly different, we'll call it, outline that I've put together in terms of what we're going to kind of cover in terms of the topics, that I would like to touch on today. So essentially, we're going to have kind of a look back, or in terms of where we're at right now. And then we're going to kind of highlight some sectors and some things that, some stocks that we see our customers at TD Ameritrade here in Singapore and in the US, either kind of maybe rotating into, or more actively trading here with some of the more recent news releases and things that markets are predicting going into 21. And then finally, we're going to just kind of highlight in terms of where we might be going, into 21, and then what types of potential strategies that you could potentially use for your trading, and a place where you can actually go look and see some of these things in our education center here at TD Ameritrade in Singapore. So this is a slide that anyone who's been trading the U.S. markets that is is familiar with. So basically, we'll go through the points here. But if anyone basically in late March, said to you, hey, we are going to have a year where nearly most businesses, restaurants are closed or not at full capacity, might not even be able to open. People are going to work from their house. People are not going to socialize. And oh yeah, by the way, we'll hit all-time highs again and again and again on the U.S. markets, over the course of summer into fall into autumn. So people would have thought you were nuts. Beginning of the year started off fairly well. If you look at the COVID started spreading throughout the world, we'll call it in late January, kind of after Chinese New Year period. And then we got to a point where markets and financial stability around the globe was really being tested. And then we saw, which many people would have not predicted, the speed and the size of the money that central banks around the globe, the US, Europe, Asia, Australia, that pumped into their economies to kind of at least give some type of safety net, so the economies, around the globe didn't implode as, the job scenes, labor departments, housing starts, shopping, retail, all these things were just basically, went from almost to nothing overnight. And then as we kind of traveled through the summertime period, then we started getting rumors, about, COVID vaccines. And then we kind of headed towards closer and closer to that US election period. And there was anticipated volatility. And we got it. In terms of, going into the US elections in late October, the volatility, or the VIX, was above 40. So it's down more than 50% on that right now. So there was some downside risk being priced into the markets. And then as we come out with more information in terms about, the COVID vaccines that are becoming made available, knock on wood, sooner and sooner. There's 170 different vaccines, in testing right now. There's 12 of them that are currently in phase 3 trials. There's 6 of them available for emergency use. Pfizer was just approved with theirs a few days ago for use in the UK. So all these things are very important to the sentiment of markets going forward. And I think more importantly, it's not just one company. There's multiple companies. There's multiple things that are very positive. The efficacy rates of above 90% on some of these phase 3 trials that we've seen recently. So this is something that as we look, and very importantly, is US markets and markets around the globe are forward looking, meaning, okay, so are markets pricing in that we're going to have this vaccine? Are we going to start to see some more stimulus in the US? Is there going to be some infrastructure spending? All these different things that might lead, so to maybe how you're looking investing into some of the markets or sectors going forward. So with that, I'll kind of just highlight some sectors that we're going to focus on here today and where we see our customers at TD Ameritrade in Singapore either kind of rotating into or more actively participating in, especially over the last kind of 1 to 2 month period. So can't have a talk about US markets this year without having a focus on the mega, big tech stocks that are, like the FANGs, Facebook, Apple, Amazon, Microsoft. All these things have been driving the US markets higher and higher throughout the summer. In fact, if you go back 2 months ago, the US S&P 500, less than 40% of the stocks in the S&P 500 were actually even up on the year. Now, over the last 2 months, it's been a staggering over 90% of the stocks in the S&P 500 are at or above their 200-day moving average. So the trend is absolutely positive, and it is wide, it is across basically all sectors. So something to kind of pay attention to as we see some of this market rotation into the cyclicals, into the value type stocks, is what are some ways you could take advantage of that, and what are some areas that we see our customers focusing on. So you'll see just at the top of each one of these things, I have some stocks listed, and then above that, and then you'll see in parentheses, these 3-letter acronyms. So those are the ETFs, some of the most widely, popular ETFs that our customers trade Now, there are other ETFs that track those sectors as well. These are just some of the ones that I focused on that we see some of the most trading activity. So some things is we're going to move around the page a little bit. So one area where we have seen our customers coming back into is the financials or the big banking sector in the United States. Now, also, we do see that across Asia, where some of the regional banks and some of the banks across Asia are becoming more actively traded, not just by our customers, but customers around the globe. And that's all part of, okay, are we going to start to see some of this infrastructure spending in the United States? Are we going to start to see economies around the globe come back online? So are these things going to help kind of drive loans and things that we need the banking system for from a business perspective? So this is something that we've seen our customers actively participating in. And if you don't know or don't want to choose individual banks, an area that you can use is that XLF, which is a popularly traded ETF with our clients, not only here in Asia but also in the U.S. In order that way you can get exposure to that sector without having to pick individual stocks, within that sector. And I'll kind of highlight that why that's more important a little bit later here on some other sectors that I want to focus on. The next thing is, we're just going to go down to the middle part of the page is the pharmaceutical sector. I mean, this has been what I'd like to call an area of extreme importance because I've said this numerous times, so goes the coronavirus, so goes the markets, so goes the economies around the world. So as we've seen more and more of these stocks out there come with their phase 3 trials and we've had great efficacy rates on their testing, we've seen some of these stocks explode in value. So I wanted to highlight 2 stocks that are kind of a little bit different. So if Pfizer, who has dozens of drugs that are in their pipeline, has a large float that, their stock value is basically years of production and distribution of drugs that have come to market. So adding one drug, like their particular coronavirus COVID-19 vaccine is going to help their bottom line, but it's not going to drive their stock price crazy like you would have seen with Moderna. So it's been Moderna mania. And this is really important. So I think if you are trading anything in the pharmaceutical space, maybe you've heard of Moderna. You probably did not hear of it before the beginning of this year. In fact, now this drug company's been around for a while, but they've actually still to date never brought a drug to fully distribution and production and distribution that has ever been approved. So this is a big deal. And that's why their stock price is so closely tied to whether they get an actual vaccine that is approved for distribution, approved for production and distribution. This will greatly drive that stock price. So again, right at the top of that, you'll see XPH, which is an ETF, which gives you exposure into the pharmaceutical space. But unless you want to have, maybe a little more exposure towards Moderna or Pfizer, if you want a little more, kind of safety in terms of the overall movement of it, this is just something, again, where if you want exposure into that sector, it's a way that you can actually participate without having to kind of, make your bet on one individual stock or not. Now, I'm going to shift your focus kind of over to the left-hand side on the bottom. Now, energy sector. This is the probably most correlated sector to the coronavirus for 2020 because it impacts the globe, the demand, travel, anything that has to do with, kind of using energy has basically fallen off the table. Airlines, cruises, the demand for oil from China, from Europe, from US is basically fell off a cliff in March, April. Now, silver lining to that, as we've seen China's economy come back online, we've seen that demand start to pick back up. So this is hopefully signs of things to come. And if we look at it, markets have been pricing in that potential coming here in the near term. Now, and if you want to look at individual stocks that are within that sector, there are 2 of the big oil companies that our customers are top of mind with our customers at TD Ameritrade, and probably for a couple different reasons. Number one is their stock price has been significantly beat up for most of 2020. And they have both committed to maintaining their dividend, which at the current stock prices for ExxonMobil and Chevron, their dividends are 7% plus, almost 8% on Exxon, and 4% on Chevron. So these are attractive looking dividend yields. And if you think that the economies around the globe are going to continue to come back online and demand for oil is going to pick back up to pre-COVID levels, or even some, right, at the beginning of COVID, then this is a potential area that we see our customers more actively participating, especially over the last 3 months as we've gotten more and more positive news around the vaccine developments and economies like China coming back online. And hopefully that's signs of things that come across Europe and the US. All right, so now I'm just going to move over to the last kind of two sectors that I have in here, because these are kind of sectors that you hear a lot about recently in the news, and maybe you aren't quite as familiar as some of the stocks that are inside of those sectors. So we actually see our customers participating across these sectors much more than they were 2-3 months ago. And it's more so in the ETFs than the individual stocks. And that is the small caps. So I put in the IWM, so the Russell 2000, in the emerging market space, so EEM, probably one of our most popularly traded ETFs over the last 2 months. So these are ways to get exposure across these things. And what I like to call them is our wild card sector, because like I said earlier, that 2 months ago, less than 40% of the S&P 500 was up on the year. Now, in the last 2 months, that breadth of the sector, net new buying is greatly expanded. And inside of that, you would then have all the small cap stocks that would benefit from a larger, kind of across the sectors, net new buying positions. So something to take a look at. And we do see our customers actively rotating some of their positions. So we do see some selling across technology. We have seen some recent selling in the financials as we've seen some of these stocks have anywhere from 10, 15, 20% rallies over the last couple of months. So we do see a little bit of rotation out of technology and banking. We also see some rotation out of pharmaceuticals as the news have come out, and it's almost like the age-old adage of buy the rumor and sell the news. So basically as those stock prices have moved up because of their positive news around the coronavirus, now we see some people taking some of those profits off the table, especially on Moderna space, as we saw an explosion in value of up over 100% in a week time period. So there was definitely a little bit of rotation on those types of moves. The next thing is just as a further kind of illustration in terms of some of the spaces in terms of what's gone on for all of 2020. So these are charts from basically the close of Thursday. And you just look at it. This is what we've seen all year. So, the first one in the upper left-hand corner is the technology space. And we've seen that go higher and higher and higher. And then if you go to the bottom right-hand corner, is the pharmaceutical space. And you'll see that that is kind of closely followed in terms of what the financials have done. And now as we've gotten a little bit better, you finally start to see that energy sector, start to kind of potentially get some foothold and maybe potentially head higher from here. So that is still one that I think is super closely, correlated in terms of, okay, now we have these phase 3 trials, we have positive efficacy rates coming out of their tests. Now, do we actually get that distribution? Then do we see the economy start coming back online? I think, many parts of the stock market are forward looking. Some things in terms of the energy space, are a little bit more cautious because there's lots of things that maybe kind of control their overall price valuations in terms of whether they are being bought or sold based on demand and supply around the globe. All right, so now that brings us, to basically, how are we looking going into 21? If you look at this chart, it's the same chart as I had up earlier, but I just took a probability of expiring cone. Now, don't worry if you don't know what that is. Essentially, I kind of put in essentially 13% up, 13% down in terms of where markets might be predicted move here going into 21 based on all the things that we see. So right now, for our customers at TD Ameritrade, especially in Singapore, it's risk on. And I will tell you, it has been risk on for the last 7 months. So those of you who aren't familiar with our investor movement index, so TD Ameritrade has an IMX, which is our investor movement index, which tracks not only what our customers trade, but also has, terms of sector strength and gives overall, trends. And we've been doing that for probably about 7 years at TD Ameritrade, and we've added in a TD Ameritrade IMX Asia about 1.5 years ago, which not only does the same type of thing, but also kind of gives some differences in terms of what we see our Asian customer base trading versus our US customer base. And it does everything from sectors all the way down to granular in terms of what are some of the most popular net new buys and net new sells for that month. And that is something you can go to TD Ameritrade IMX or simply imx.tdameritrade.com, where it gives you that overall kind of value in terms of what we see our customers doing on a month-over-month basis. Now, if we look at this, and from the information that we have in terms of, there's two sides of the coin. All right, we have potential stimulus out of the US, we have vaccines that seem to be gaining momentum in terms of are they actually going to get approved and distributed. We see a lower for longer Fed in the US that's potentially going to help keep markets either stable or potentially bullish kind of going into here in the near future. Now the flip side of that coin is, okay, the distribution on some of these vaccines potentially could fall apart or not work as well as expected. When the drug actually starts getting administered, the efficacy rates could be not as good as they've been in their trials. Stimulus, we've been talking about the next round of stimulus payments in the United States since before the US election. It became a very political thing. Well, we're still waiting. And Congress has basically got about another week until they're out for the rest of the year. And, so will we ever get that stimulus payment? Will we get it here by the end of the year? All these things are things that are going to help drive not only markets, but the sentiment of the markets going here into 21. So if you were looking at that and you were unsure in terms of where you might want to be investing in markets, whether it's in some of those sectors that we previously talked about, and if where Howie talked about a potential W-shaped recovery where there still might be some choppiness going forward. Well, one of the areas that we like to teach people about, and it's something that I'll show, I have a page for in the next slide that tells you where you can look it up, is we have an education center that is available for anyone, whether you're our client or not. If you do have a registered username and password, that actually unlocks additional pieces of content that's inside of our education center. And one area that we like to focus on recently, if in times where volatility is higher than normal, so right now we're back down to in the low 20s, but if we start to kind of creep up towards high 20s or in 30s, like what are some strategies that you might be able to employ in times of higher volatility? So that is a key area that where we focus on these things inside our education center, where we talk about different types of strategies, whether that's selling put spreads, if you think that the market is going to continue to head higher, or if you want to put you think a certain sector might head higher, or on the flip side of that, if you think, well, maybe technology, is a little bit on the high side right now, and you want to have a potential, bearish type position that has defined risk, we talk about selling call spreads. And why I talk about that is more popular in terms of higher volatility is because when volatility is higher, the option values pay you more money to put on these types of trades. Now, it's kind of hard to go into that in just a 25, 30-minute demonstration. So that's why I'm going to have on the next page where you can actually look this up on our education center in terms of strategies that you could employ going forward if you think volatility is going to remain high and you're uncertain about the overall movements in the stock market, and be able to take advantage of that throughout your portfolio. Now, I'm in the camp that the markets are in a much better spot than they were pre-COVID. And that is really for this unbelievable coordinated effort around the globe that central banks pumped so much money into economies around the globe. Now we're coming to a point where are we going to continue to see economies come back online like we've seen already starting in China? I know we're having, the kind of these third and fourth waves across Europe and the US. But, as we get these vaccines, being rolling out here, by the day, it seems. And is that just are we going to see that recovery start in Europe and the US? And if we are, these things that are super bullish in terms of where we think the US stock market might be headed into 21. So I've said this, numerous times, there are areas that we see our customers trading more and more into. There are certain areas of strength. And it is, I sound like a broken record, but look, so goes that coronavirus, so goes markets around the globe, and so goes economies around the globe. With that, I'm going to leave you with this is our last slide, and we'll be sending these all out to everyone that's on this call that is registered, their email address. This is our TD Ameritrade Education Center that I've mentioned. Now, inside of this, we have on-demand videos, articles, education, how to use our trading platform, and all of it's 100% for free in order to help you kind of better your trading strategies and learn about new tips and tricks that maybe you didn't know was available to you through our trading platform here at TD Ameritrade. With that, I would like to say thanks and look forward to talking to a number of you or answering your questions in the Q&A period.
Right. Thank you very much, Chris. And do post your questions for Chris in the Q&A section. And please feel free to vote for your favorite question so we can answer them during the upcoming panel discussion. So, right now we'll be going for a 5 minutes break before the panel discussion begins. You can go and get a coffee, take a toilet break and stuff like that. And see you back in a bit. Thank you. Hello everyone. Welcome back to the Year-End Investment Forum. We have come to the last and most exciting part of our webinar, the Q&A. I'll be taking questions from the audience for our speakers to share their views. So without further ado, let's welcome back our esteemed panelists, Professor Pushan Dutt, Howie Lee, and Chris Brankin.
Everybody.
Right. So with that, I guess we could start the Q&A session proper. I'll be opening with a couple of questions that I thought about maybe coming into this forum. And the first one will be for Professor Dutt. So recently at the top of the news, there's been this sort of like a development where Chinese President Xi Jinping has just announced that China will consider joining the CPTPP, the sort of like successor to the Trans-Pacific Partnership Trade Agreement. So I was actually wondering, how do you actually see this affecting the state of US-China relations and the regional economy going forward?
So as a trade economist, I think that there has been too much of a proliferation of these regional trading agreements. You know, if the globalization gains are to persist going forward, it should be done on a multilateral basis and not so much on a regional basis. So let's set aside that concern, which all economists have, and think a little bit about CPTPP. We should keep in mind that the TPP was essentially a way to form an alliance of like-minded nations, and it was explicitly targeted to keeping the Chinese out. So the Chinese actually have incentives to join that. The big question then becomes that what does the next US President Biden do in terms of, does he go back to the Obama policy of the Trans-Pacific Partnership, or does he, which actually has China outside it, or whether they actually bring China inside the fold? My guess would be, and these are all guesses, that he's likely, the US is likely to try and keep China outside any version of the Trans-Pacific Partnership going forward. So there is a movement towards deglobalization and decoupling, and building resilience in supply chains, and having China inside the CPTPP does not actually agree with this. So I think the RCEP, the one which was signed, will persist, but I'm skeptical that the Chinese will be allowed to join the TPP if the US actually takes the lead on it.
Thanks, Professor Dutt. And perhaps following on with that, do you actually see this announcement by President Xi actually prompting the Biden administration to consider actually coming back into this sort of regional trade agreement and re-engaging with it once more?
Absolutely. So I think that's, there will be like a push towards repairing relations with their, traditional allies like the European Union, taking up a bigger role, which is not, extremely, conflict prone within Asia Pacific. So right now, currently, just to give some context, there's a big spat going on between China and Australia, which also is going to play into the consideration of whether they want China inside the TPP and other regional trading arrangements. So I think there will be a push towards isolating China going forward. I'm not saying that this is a good thing. I'm just saying that this is essentially where the politics of the matter is currently.
Okay, thanks very much, Professor. And the next question is for you, Chris. So it's about the sort of Senate races that are currently up in the air in the United States, because as we know, because of the sort of close results in the Senate seats in Georgia, there is right now runoff elections to decide who actually is able to control the upper house of Congress in the next term. So between higher taxes and regulations under a Democratic Senate or a smaller stimulus with a Republican Senate, which do you think markets are actually more concerned about?
Well, look, this is something that you hear all the time. Markets like clarity, but I think markets are pricing in that the Republicans will win those seats in the House, and markets like that. And I say why they like that is because a change in administration in the White House coupled with a split Congress generally means that a whole lot of wide sweeping legislation will not get passed. And the status quo markets like, so I think if you had to compare stimulus coming or not, versus increased taxes. I think markets are more concerned if there was a wide sweeping tax reform in the United States that was brought on by the Democratic administration. That would be more impactful in terms of businesses. And the stimulus one is just this thing that keeps going on and on. Look, there's lots of people, tens of millions of people that have been, out of work in the United States that are really relying on getting some type of additional stimulus payment. So I think it became too politicalized in terms of not wanting to have Donald Trump's name on that check before the election in early November. But now we're past that. So I think, the legislators in the United States need to get their act together, so to speak. But I think markets are less concerned about that stimulus payment than they would be if there was wide sweeping reforms around taxes.
Okay. And given that markets already priced in that the Republicans will win it, what do you see happening if, say, in a sort of like the Democrats actually manage to successfully bring about an upset in Georgia? How do you think?
We'd see volatility increase in markets for sure, because at that point, then there's concerns. All right, now is corporate tax rate going to go up? Are they going to be able to pass more legislation in terms of, more government spending, more, infrastructure spending, all these things that the U.S. would have to pay for somehow? You would see some increased choppiness in markets by a lot. You think volatility at 25 is pretty high. I think you would see it spike, back above, the pre-election levels until we got to know a little bit more in terms of what they're trying to do. But like markets are not pricing that in. I'm not in the camp that that's going to happen right now. But yeah, that is something that can happen. I think we see a lot of optimism in the markets around whether it's vaccines, stimulus payments, whether it's, infrastructure spending, all these different things. But yeah, there's a flip side to that coin. Like, if the Democrats can, win some of those key seats, and then they'd have a little more control in terms of what legislation might get passed in the U.S. That would be something that would definitely add some near-term volatility to the markets, and that would happen almost overnight.
All right. Thanks, Chris. Right. Now, Howie, over to you. So I actually had some questions for you, but I think from our audience, there has been this overwhelming call for you to actually show them the sort of forecast for SG stocks over the next 12 months. So I was wondering whether you could give us that sort of like outlook for our audience that you were not able to explain earlier during the session.
I noticed a lot of questions were centered on Singapore stocks, and maybe just I've answered a lot of the Q&A as well on the platform, but let me just briefly run it through again. The reason why we see the STI having underperformed most of its other equity peers is because there is a conspicuous lack of tech counters in the STI index itself compared to, let's say, the S&P 500 or maybe the tech-heavy NASDAQ. And that's why we see, whereas the rest of the S&P 500 have clocked gains of 10% this year, STI is still probably mired slightly in the red for now. Broadly speaking, I think if we expect equities to rally into 2021, as we have spoken earlier, the hot money flows, the expectations that asset prices are going to continue rising, risk appetite from the vaccine dissemination, we expect the STI to rise in broad tandem with all these other equity indices. But if you were to ask me, I don't think it would be the standout performer in 2021 with EM counterparts like those with higher yielding differentials probably boasting the better prospects in this region, or hot money increments in Europe and in the US. Those will be the pick of the cherry as well.
Okay, thanks very much, Howie. So actually the follow-up question to this will probably be for Howie and Chris at the same time, because I'm going to ask this question as a sort of retail investor, someone who's also trying to look into stocks as well. So for many of us, we see all these like developments happening, but we often find that now the prices are going up. It's very hard for us to sort of like tap on this sort of situation. So do you think investors have missed the boat, and what sort of areas of value do you think still exist right now within markets?
Sure, I'm happy to take that. Look, there's probably one of the number one questions that I'm asked on a given week to week or month to month basis is, where they think the prices are going. Is it too late? Should I buy now? Look, we don't have a crystal ball. But what I will tell you that what we see from our customers here at TD Ameritrade in Singapore is 70 to 75% of our retail trades are in the derivative space, and more heavily so in terms of options. So the options space allows you to put on a strategy that is either bullish, bearish, or neutral. It allows you to have defined risks. It allows you to define how much capital you want to spend. So you can spend way less money in terms of going and buying the stock outright by putting on types of option positions that you can learn about in our education center or any of the events that we do. So that's where I see, like, if you think that you, in the near term, it might be coming back down, or you think it's going to continue higher, you don't have to literally make a binary bet of I'm buying the stock or selling the stock. There are different tools and strategies available to you, which we see literally almost 3/4 of our month-over-month trades are done in the derivative space.
All right, thanks, Chris. Howie, do you have anything to share with regards to this?
Well, I was having coffee with one of the bank CIO yesterday, and I was perhaps a bit surprised to hear that many investors actually think equity levels are overvalued, and they may be. I think they could be. But in a climate as such, with the amount of support given from central banks, the amount of money is chasing too few goods, the broad risk sentiment, how inherently bullish the market is at this point of time, I was a bit surprised to hear how people are still focused on valuations at this point of time. And it may come a time where people say, all right, things are overvalued, like you're saying, prices are too high, and perhaps a correction is needed. But from what I am gathering and from what I think of how this market is going to perform is that each and every time we see a decline in prices, there will be a lot of money waiting on the sidelines, waiting to pile into the markets again. And the valuations, I think, would be a question perhaps the end of 2021 or when things start to normalize in 2022 in terms of both the virus situation as well as when central banks want to normalize their monetary conditions. But I don't think it would be a big standout focus for the markets in 2021.
Great, thanks very much, Howie. So Professor Dutt, back to you. So there's also this question with regards to US-China sort of rivalry, that what happens to the states caught between it? Like Singapore, for instance, our Prime Minister has been going around all these international forums saying that Singapore doesn't want to choose sides, we want to have good relations with both sides. Do you see this as being possible in a world of greater bipolarization where the US and China have decoupled? And how do you think should be the sort of strategy that small states can actually enact to be able to have like good relations with both the US and China economically?
So this is a challenge which all these small states will face. There is this well-known African saying is when the elephants fight, it's the grass that suffers. And of course, there are some upsides to it as well, because this happened for Vietnam, for instance. A bunch of supply chains actually left China during the trade war. And they moved to Vietnam, and that's why when Howie was showing those numbers, part of those numbers actually reflect that. So essentially, a lot of diplomacy. They have to think about making sure that they are on the right side of issues and neutral in many issues. I think neutrality is going to be a key aspect for Singapore going forward. This is going to get harder and harder if we start moving into more and more of these conflicts on the trade front, on intellectual property regime and things like that. One of the things for all these small states to consider is that they actually benefit a lot from a level playing field, because they simply cannot push for policies or design policies in the international arena that benefit them. So for them, actually getting together and going through multilateral forums and pushing countries to go the multilateral route rather than the bilateral route, these are various ways in terms of buying insurance.
Great, thanks, Professor Dutt. The next question I have is for Chris as well. It's with regards to this idea of Chinese firms being delisted in the US. So I was wondering whether you see further sorts of like such policies taking place under a Biden administration, because as I understand, a bill is already sitting on President Trump's table right now to have certain like Chinese firms in the US be delisted from US exchanges.
Yeah, with the bill for the delisting of stocks, Chinese stocks, it's more of about getting a level playing field in terms of the reporting. I don't know all the details behind that, but I know that there is a window of time that they are allowed to get into basically into line in terms of the reporting standards that would be available. Look, some of that stuff it kind of gets a little political, in terms of where we've been with Trump and his administration. Is that going to change a little bit with Biden? I think Biden's camp would say that, like, hey, look, they're more open and have more of a normal kind of chain in terms of their negotiations for some of that. So hopefully some of that noise in the market goes away. But look, some of that is a little too early to tell in terms of what's going on with why some of that stuff is being brought to the forefront right now. I think it's always kind of been out there, but it's just overall concerns about how the listings are in the U.S. market, which might drive listings in Hong Kong and China. If some of these Chinese stocks can't be listed in the U.S., they're going to want to list somewhere.
All right, thanks, Chris. So Howie, the next question is for you, and the question I have is with regards to the asset inflation point that you actually mentioned during your presentation. So when I looked at it, it seemed to me quite concerning because there seems to be parallels to the sort of 1980s situation of stagflation, where there was high inflation and low growth at the same time. So what do you see as being similar or different between such scenarios, and what would this actually mean for the sort of global economy going forward?
Well, I get a point about the 1980s stagflation, but in my opinion, we are facing a very low probability of inflation ever creeping higher in not only now, but I think in the next 10 years. There are many structural reasons to that. I would take an hour to explain each and every point to you. But generally speaking, I think Europe and Japan have shown us how tough a deflationary spiral can be. And if the rest of the world are not quick to arrest it, I think we might follow in the footsteps of those. So as far as inflation, what we think inflation would be in the near term, meaning the next couple of years, due to the low base that we are seeing this year, due to the oil crash, most probably inflation would be higher than this year in 2021. But that's not to say that we are seeing inflation creep higher. In 2022 on, when things normalize, I think we'll start to see inflation levels start to moderate themselves again for developed countries around the sub-1, specifically the US, Europe and Japan will be back to battling deflation spirals again. And on the other hand, growth will continue to moderate themselves. So I think we are seeing a low growth, low inflation kind of story, more so than a stagflation basis, which is high inflation, low growth. Having said that, I think a big part of my presentation earlier was speaking about inflation expectations on asset prices, not on consumer prices. It's a new kid on the block, like I mentioned earlier, which means that the money that's being channeled amazingly has not gone into Main Street. They have not jacked up the price of basic goods and prices, but have instead gone on to raise levels on equities and property prices and even on the credit space. And it's a bit difficult to pull back and control asset inflation because from authority and from a central bank point of view, there is no real need to compare to consumer inflation run away, because consumer prices being too high hurts the average guy on the street, hurts your direct impact of living. Asset bubbles, on the other hand, hurts a handful of people, a handful of wealthy people, not the average guy on the street, and more often than not makes you wealthier than before. It's a way of course, driving down your debt to asset ratios, but I won't go into that. And it takes a lot for authorities to act on asset inflation, and that is why we think it might persist in the mid to long term at least.
Great, thanks very much, Howie. That really clarified the situation that we are going to find ourselves in going into the next few years. So with that, I'm going to look at some of the questions that have come up for us from the audience. And I think the top garnering question, aside from the one about the sort of like equity sort of situation going forward is with regards to the sort of decoupling between China and the US. So Ani Dinasan asks Professor Dutt whether you see more of these Western states decoupling from China and aligning with US alliances, and how do you think China will tackle this? I think it's some sort of like question I would interpret as being maybe in regards to sort of potential diplomatic isolation and the sort of impacts on the Chinese economy, perhaps.
Yeah, so it's actually not entirely correct to say West versus China. You know, you do have a singular power on one side, which is China. But the Western alliance is actually not as united as it used to be. So just within Europe, for instance, you know, Brexit is looming large, and you know, Brexit might, and the UK might actually crash out. So there's a lot of tension within Europe between UK and the rest of the European Union. Within European Union, there's a lot of tension between countries like Hungary, Poland, and the rest of Western Europe who want, you know, to push liberal democracy, whereas the leaders of Hungary, Poland are actually, you know, putting lots of things in place where they are, you know, violating things like freedom of press, the rule of law, etc. So there is no one West as such. So that makes the lives of these countries and their ability to agree much harder. China can actually strategically exploit some of these divisions. But China also is becoming increasingly nationalistic and bellicose post-pandemic, and I think it is sort of hurting itself. A good example of that is in the fight with Australia. So if I were China, I would actually try to create a wedge between Australia and the US. By being so aggressive against Australia, they're actually driving Australia and China into one camp. So decoupling will require on the Western side coordination amongst multiple partners, which is going to be quite hard. We saw it didn't happen during the TPP, so it's still going to be tricky going forward.
Okay, thanks very much, Professor. And Howie, the next question is for you. It's from Terrence, and it is about digital bank licenses that have been just announced. So how do you see this actually affecting traditional bank earnings going forward?
When I saw the news yesterday, I figured that this would be posed to me this morning. I mean, from a bank's point of view, I might be limited in the amount of scope I can answer this question, but traditionally speaking, and on a historical point of view, banks have survived the test of time. And more so in modern days, they have gone through the Great Depression, they have gone through the GFC. Each and every time people think banks are going to drop off, they actually do come back. Maybe not as strong as ever, but on a balance sheet term and on a regulatory point of view, I think they have survived each test quite well. The digital banking license, I don't necessarily see it as a challenge to the traditional banking sense. I think there's a lot of scope for cooperation between what we call the normal banks and what we call digital banks, right? On the traditional banks do have a lot of room to play in terms of product innovation, in terms of risk taking that we are allowed to do from authority point of view, the amount of jobs that we give out to the population. But I think, of course, with the amount of advance in technology, we should not overlook the kind of convenience that the digital licenses, banking licenses can offer to traditional banks. So the best outcome from here would be marriage between these two sectors, where we can leverage off each other's strength. And I think we will come out stronger and even better than before. I don't think this is us giving out our margins and our profits to a new competitor, but rather I think it's a harmony of two brands coming in.
All right, thanks, Howie. Next question is for you, Chris, and it's with regards to perhaps electric vehicles. So one thing I've been noticing when I was passing through the questions, that there's this great interest in electric vehicle sector going forward. And I was also wondering, connecting this with the recent result of the US elections, as we know, Biden is probably more ESG driven than his predecessor. So I was wondering how this interacts together with this growing interest in electric vehicles, and how do you see that sort of stock sector going forward in the future?
Look, I mean, the EV space is something that is highly, terms of, highly kind of looked at in terms of valuation, in terms of where we're at going forward. And I say that for a few different reasons. Because look, you have Tesla and the whole kind of Tesla mania that we experience, and their stock split and the prices just go up, 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 where in fact other EV companies like, GM produce and make way more cars than the valuation that they're given based on, Tesla and the kind of coolness factor that Elon Musk is driven. So I in terms of price valuation, it's hard to kind of pick right now because you have a number of companies that are going to get more and more involved. You have companies out there that are more well-established, that have been in the markets for a longer period than Tesla, that make and produce and sell many EV cars that their valuation of their stocks are significantly lower than if you look at a Tesla. But it's in terms of, Biden's administration, yes, I would think that, from a planet perspective, I think that he would always be, I think, seen as a more, pro towards the ESG space. And I think that would be nothing but positive towards that EV sector as we kind of get more into 21 and beyond.
Right. Thanks very much, Chris. And moving on from there, just to follow up as well, there seems also to be a question about valuations from an anonymous attendee. And it says, what are your views on current valuation metrics in valuating companies with potential of achieving exponential growth, and how we should value these companies? So I was wondering maybe you could give some sort of input into that. They mentioned things like LMND, TSLA, TTD, DOCU, and stuff like that.
Look, so I think this is something we talk about a lot. So you have some of these mega tech stocks. You have stocks like Tesla. You have where these PE ratios are outside of what a normal traditional PE ratio would be on a stock. Look, on some of these tech stocks and companies like Tesla, like I'm telling you, like the P doesn't really stand for price anymore. It's more on potential. So I think in terms of looking at straight valuations, I think these companies would look like they would be somewhat stretched on valuation. But you would, markets can stay irrational longer than you can stay solvent. So I wouldn't fight that overall trend in terms of that potential that these stocks have going forward is outside of the normal, in terms of just looking at a PE ratio to think that the valuations are stretched, that you think the stock's coming down. Like a lot of people would have lost a lot of money this year betting, lining up their portfolio that way. Right.
Thanks very much, Chris. And
let's weigh in on the valuations point of view. Let's put it this way, all right? And I think it requires a whole rethinking of how we view the tech space. And let me put it to you in a very simple manner. CapitaLand malls, any malls for that matter, when you buy a shopping mall, you build a mall, on your balance sheet you have capitalization, right? You have plot of land, you have the value of the building, you try to maximize the space. But for a tech company operating in the same manner without that brick and mortar space like Amazon, the amount of investments that you put in cannot be capitalized, so it's expense. And that's why people see negative cash flows on a lot of tech stocks and somewhat depressed profit margins on it. And people are saying, oh, negative cash flows is a bubble or overpriced indicators on PE levels. But I don't think it's the right way to look at it. Tech stocks are in a different world of its own, and I don't think we can apply the traditional matrices to look at it. I think we have to understand what PE ratios stand for, how they are calculated, try to frame it in the new space that we're looking at, especially with the COVID-led surge in the tech sector. And then from there, see how we can adjust our way of looking at it. And my guess is that you cannot apply the traditional way of looking at your brick and mortar stores or what have you onto the tech space. So I'm not saying tech is overvalued or undervalued at this point of time, but to persistently use the idea that tech stocks are negative cash flows, P is out of whack, I don't think that applies to the new paradigm.
All right, thanks, Howie. Maybe I want to throw the question back to you as well and asking, how would you actually value tech stocks in that case? Do you have any sort of like metrics that you have in mind?
Not at the top of my head. Like we said earlier, people like us who have come through the whole finance business school, we have done our CFAs, we are so ingrained in this. And it only took us such a seismic shift brought about by COVID to let us to understand that what we have always deemed to be overbought tech stocks, and of course, with the historical experience of the dot-com burst in the 2000s, leading us to think that this won't be sustainable again. But I think we're living in a very new world, and as such, to look at tech stocks from a normal stock point of view, or value it from that normal point of view, I don't think that is going to work out for us going forward. And that's what we meant, or that's what I meant at least, by a new normal, where we have to think of new innovative ways to look at different sectors and different companies.
Right, Chris, can I bring you in and gather your thoughts about how you think about the sort of alternative valuing methods for tech stocks, and if you do believe that that's the case, what sort of metrics would you use to actually select such counters?
I mean that ties into what I was saying in terms of the P is more of a potential than it is for price on some of these tech type stocks. Look, I'm not an analyst. Basically when we're looking at overall price movements is we like to talk about where we see our customers, our over 12 million clients across Asia and the US in terms of what they're buying and selling, and just in terms of what it is from month to month, and everything from a sector down to a granular level. And that's part of that investor movement index that we release every month. And actually the new one comes out here next week as well. So we're not in the business of picking stocks and telling you which ones we should buy and sell, but we do like to share in terms of what we see our overall trends, where we see actual cash flowing in and out of, and in what sectors and stocks that we have in the US.
Right, thanks, Chris. So the sort of next question I asked is for Professor Dutt, I guess. Back to you. So it's more of a sort of economics question than geopolitics question, because I'm noticing in regards to the interest rates over the past few years, even before COVID-19, the interest rates have not exactly recovered back to pre-COVID levels, even before even in the last 10 years. And even now, at the moment, with this additional round of QE infinity, it's likely that interest rates are going to stay low for quite some time to come. So I was wondering, as an economist, whether you see us entering a sort of permanently low interest rate environment, and if that's the case, what sort of implications it could have for global economies.
So I think we will stay in a low interest rate environment for a long time. Both the last few Fed chairs have actually, the Fed started increasing interest rates under Janet Yellen. And that is widely regarded as a big mistake, because there was fear of this inflation beast around the corner, and the inflation actually never materialized. Why did this happen? The reason this happened is many of these central bankers actually grew up in the hyperinflationary episode of the 1970s, during which Paul Volcker raised interest rates massively and killed off inflation. But they were scarred by that episode. All central banks, like the Federal Reserve, has this dual mandate of managing inflation and unemployment. But because when they grew up during the Volcker episodes, they've always been very scared of inflation and managing inflationary expectations. This led to a series of errors during the global financial crisis, and essentially, recovery took a long time. It literally took 10 years before labor force participation rates, unemployment rates, even incomes for certain segments of the population actually recovered. Luckily, these are economists. They are sort of Bayesian, so they've updated their price, they've updated their beliefs, and now, they are going to keep interest rates low for a long time. In fact, they're becoming even more flexible about it. They're not even forecasting inflation. They're actually forecasting that the inflation targets are now a band. They are no longer a single number. The band essentially gives them flexibility, so that if sometimes inflation comes ahead of forecast, that doesn't mean they're going to tighten preemptorily. But of course, the problem with this issue is that this has led to asset price inflation, which Howie has been talking about. The asset price inflation essentially has become the Greenspan put on steroids, which is that markets now expect that any time asset prices actually come down, they will get so scared of financial market instability and a looming recession or a crisis, that they're going to not just reduce interest rates, but also do these kinds of QE infinity that you're talking about. In the short term, I think this is the correct policy to use, especially because fiscal policy, the US seems to be having very strange discussions, especially the Republican Party, about the need for fiscal policy at this time. The need for fiscal policy is actually extremely urgent. And here I disagree with Christopher, where I think if the Republicans win the Georgia seat, they are actually going to go back to fiscal austerity, and fiscal policy is less likely to happen. Whereas if the Democrats come in, it is more likely to happen. The longer term problem with this is that this is creating these asset bubbles all the time. And we know that asset bubbles are sort of, eventually they're going to burst. The key question to ask is whether this is creating systemic problems within the financial sector. This was a problem during the global financial crisis because the bubbles were in mortgage-backed securities and complicated derivatives. Here, this is no longer the case. I think both Howie and Chris sort of mentioned this. This is so, there's a huge, is there a tech bubble or not? I don't think anybody has the ability to answer this. That's why all of us are sort of dodging this question. If the tech bubble bursts, this is just a redistribution. Some will win, some will lose. The key question always, and that's the Fed's mandate, and that's what all central banks look at, are whether there are systemic risks or not. At this point in time, there doesn't seem systemic risks, but we should always keep in mind that no two crises are alike. Regulators always fix the right crisis, and financial markets are innovative enough to generate a new kind of crisis, a new kind of risk, which we do not anticipate. Only in hindsight, we say, of course, we should have seen that. So what's the next thing that might blow up the markets and lead to like a really big crisis? We simply have no idea.
Right. Thanks, Professor. And I have so many questions to ask following up onwards from all the sort of rich discussion we have, but unfortunately we are slowly running out of time, so it's time for perhaps the last question just to wrap everything up. So my question for all the panelists, and I hope you'll be brief on this to ensure that we can finish on time for everyone so they can go have lunch. What do you see as perhaps the biggest wild card that is going to happen in 2021? What do you see as being the thing that could potentially create this sort of like chaos and uncertainty going forward into the coming year? Starting with you, perhaps, Professor Dutt, then followed by Howie, then Chris.
I think it's the vaccine, right? So the numbers which have come out, and this is something Christopher has been saying again and again, as goes the coronavirus in this case, as goes the vaccine, so goes the world economy. I think the biggest black swan event, the unknown is around the vaccine. The numbers which have come out are extremely good, but normally vaccines, the last major successful vaccine took 4 years, which was the mumps vaccine. Now, there might be something which pops up, which we have not anticipated because it's not been around for a long time. Is it efficacious in children? Is it, can it lead to some other thing? Once we get a large sample, we start seeing these problems. I do not think this will happen because these are well executed studies, but this is literally the unknown. And if that happens, then I think all the optimism which has been built into asset markets, into the global economy, into V-shaped recovery, etc., this will be a massive setback if that happens.
Right, over to you, Howie.
Agree with Professor Dutt. We frame questionnaires all the time. We have to list risk 1, risk 2, risk 3 in that order. So risk 1 is definitely the vaccine. So I won't elaborate more on that. I think second on the list that we are seeing is the premature withdrawal of stimulus, maybe overconfidence that the vaccine will do its job. And then we see a pullback in terms of monetary and fiscal aid, which at this point of time will be very premature, too early, especially from the monetary point of view. Some countries have already started thinking about it. I think China has led that front, but but China, of course, is a different league on its own. It's a first in, first out kind of recovery, but it would be a mistake for the rest of the countries to think that they could follow in China's footsteps that quickly. Right.
Thanks, Howie. And Chris, you have the last word for today.
Well, yeah, if I could pull out my crystal ball, I wish I went first in this one because I obviously vaccine is going to definitely be one of the things that's at the forefront of everyone's mind. But if we not focusing on the vaccine for a moment, for me, I think the biggest risk is, okay, let's hope the efficacy rate stays high, the distribution, starts happening soon. is the decoupling of U.S.-China, I think, would add some increased volatility and increased kind of geopolitical risk that maybe is not priced into the market right now. But, look, again, let's hope the vaccine starts getting distributed and works here soon. And we get back to a little bit more sense of norm in terms of how we're actually looking at markets, going into 21 rather than this tumultuous volatility ride that we've had for most of 2020.
Right. Thank you very much, Chris. And with that, we've come to the end of the webinar. Thank you, Professor Dutt, Howie, and Chris, for sharing your fascinating insights on the year ahead. To our viewers, thank you for joining us and for your amazing questions, and we hope you enjoyed today's discussion. Should you wish to receive the slides for the past sessions, do share your feedback in the survey on the screen now. This webinar was brought to you by The Edge Singapore and sponsored by TD Ameritrade Singapore. Do subscribe to us at www.theedgesingapore.com for more updates. Thank you and goodbye.